that's a definite no. I think you need to have an independent board of directors at least 6 quarters before go public or before you file for going public. You need to start building the trust and relationship with your independent board. You need to start, also putting together the frameworks for what does good governance, what does good corporate governance look like. Because over time, while there is always a sum of parts valuation that you will get depending where your cash flows are stacking for each of your business units, what is the intangible premium that gets built on top of that is what I call the corporate governance, right? Or corporate governance premium. Now, that's a personal KPI that every founder or CFO in their company should take, that we should be valued more than our sum of parts, which objectively, comes along.
Sorry, let me understand. So the founder must have a KPI that I should be valued more than?
More than the objective valuation of peers that they get in the market.
Don't founders already have enough work to do?
Yeah, so yeah.
Why can't we delegate this to the CFO?
Sure. No, the CFO is, as I said, it's kind of vetted, right? I mean, the entire CEO, CFO, the founder, CFO equation is a trust-based one. So at Swiggy, we have decided that, all fun and all the fun things Harsha will do and all the boring stuff I will do. So you don't find Harsha, participating in many of these stuff, but and he, continues to build products.
But jokes apart, actually what Rahul is saying is true. In the Indian markets, companies that are trusted for their management, and that absolutely includes the founders, actually do trade at a premium. It's nearly a 20% premium.
Absolutely, and every sector, when you start looking at around, just pure play, objective valuations basis, say the cash flow profile, you'll find some outliers. And when you kind of look back at the history, this governance premium that comes along comes with the back of, the management team. It comes at the back of the, the way the board, conducts their operations in the company. It comes around with transparency, governance, a lot of factors, communication, right? So I think good news, travels obviously fast, but, bad news should travel by an escalator, right? I mean, that's what we say, that, you should always have bad news traveling even faster than good news, right? And that's when markets will start trusting you.
So I've always believed that in education, there is a value system that gets recognized. It's good to see that in public markets as well, that is the case. But I want to switch gears a little bit. I mean, we've been talking a little bit about the process of how to be public. But let's go back to the fundamental question. Should a company even go public? Now, let me rephrase that in the context of education. And we had a speaker earlier today who said, by the way, in the US context, that if you want to be successful, never go public. You would rather get better valuations being private than going public. The other angle to keep in mind is, as companies in education, we work with predominantly not-for-profit, whether it's universities, whether it's school systems or administrations. And does it sit well when they see a public company and all of the visibility and stuff that goes with it? So that's a unique thing to education. But in general, how do you think about this staying private for longer versus going public?
No, see, my personal belief is that every company, should aspire to, be in the public market. I think, I mean, you see, if we are a consumer brand, the kind of, say, coverage that we get, just being a consumer brand now while being on the listed space is phenomenal, right? So while they say IPO is a financial event, it's probably the single largest marketing event that ever happens in a company's life. Now, this is true even for, say, the education sector. I mean, while many of you who deal in it, I mean, the kind of media coverage, the kind of, even, say, the consumer's awareness that goes along with listed space, and especially if you kind of take in the Indian context, you'll be surprised the number of demat accounts and the number of market participants that have, quadrupled in the last 3 years, right? So I think there are some statistics around there being 40 million demat account holders, pre-COVID, and as of today, that number is 200 million. So there's been a 5 times increase in the number of, say, retail investors in the country who are now starting to, enter the financial markets. So I think there is obviously this large event, which is like a marketing event, the kind of media, as I said, the kind of consumer awareness scores that go up. We have started to see that ourselves. Though, I mean, it helps that we are a consumer brand and, something, a high frequency brand. Having said that, I think there are lots of other reasons that, you need to go public, right? I mean, if you have taken, for example, external money, there is an exit that you will have to provide to your investors at some point in time. Now, while in the US, we have seen there's a very active secondaries market and, a private market. In India, unfortunately, that's very restricted. And it's very hard to, get large exits. Recently, that, phenomena is changing. I kind of make this comment that, right, if you look at the number of shareholders that, went up even before listing for us, right, because there's a large secondary market that's opening up. I think we had an investor count of 40, and by the time we got listed, even before listing, that shareholder count base went up to like 20,000. Now, these are, just between, say, you flipping public and listing, that period where there's a lot of, secondary trading that started to happen, means there's a lot of active interest amongst investors to, come in. So, yeah, I think it's important to, this whole investor exit. I think one factor that gets missed out is the whole employee, bit, right? Employees who joined early with a certain risk profile that comes along joining startups, the kind of wealth creating, wealth unlocking opportunity that it creates, this whole public market, listing, I think it often gets undermined. Today, if you look at Swiggy, we have more than 3,000 employee shareholders, right? And across the years that we have built, and many of them joined. So even if you take my example, see, I was actually, based out of India. I was in Singapore, in a multinational corporation. This was, 2017. I was starting to get bored of what I call my escalator lifestyle in Singapore, saying it just looks too boring, and it looks like I'm destined to just retire here. And that's when I started to, think around either starting up or joining an early stage startup. And, started to speak to a few founders. When I, met the Swiggy founder, really liked what he was building. And I thought this was a real problem statement that wasn't solved. And if I could join them at an early stage and scale up and really be part of creating something versus just making large things larger, which is what I had done in my corporate life. So that was a huge motivator for me to come back to India after 9 years and, build Swiggy. And I think sometimes you need to take some of these risks. And I think this whole employee bit is very, very important again.
Definitely the fact that last year so many Indian companies have gone public and so many early employees have actually made money, and the currency now is actually, is currency. It's not just paper stock. Actually, has helped that startup ecosystem a lot. Okay, let me
just one more thing. If you look at the number of, say, what we call now the Flipkart mafia or even the Swiggy mafia, the number of the entrepreneurs who are getting born out of this ecosystem. I think Flipkart has more than 250 startups who have been incubated by Flipkart, and similarly in Swiggy we have close to 50 founders. I just met one here, Anushri. She has started up in the edtech space. So I think it's amazing to be able to incubate just so much entrepreneurial talent while giving a lot of the employees the freedom to choose. Having maybe got some of this.
Yeah. So we can't have a full conversation without me bringing in Zomato. And for those of you who know, that is their largest competitor, perhaps most direct competitor. But Rahul has given me permission to ask this question, which is, Zomato is now a $30 billion company. If I'm not mistaken, the P ratio is like 129. So it's crazy. I'm not sure all of us understand what's going on. But specific to Swiggy, your revenue, I know the mix is different, etc., Rahul, but it's somewhat comparable. And actually last year, fiscal 24, they grew 40% and Swiggy grew 80%. So you're kind of similar size, maybe growing even faster. But why is Swiggy at 12 billion in the public market and Zomato at 30 billion?
Yeah, I mean, I'm very happy that where we are. I think we continue to build for the long-term continuing shareholder. The only entity that I think we need to work for is the long-term continuing shareholder. So as long as that entity, remains on your cap table, it could be an imaginary one or it could be a real one. And that is why balance sheet investors, long-term, capital providers is one, again, area where I'm focusing a lot on. That how do you get really solid, investors who are willing to back you for your lifetime? Because, as young startups, you need to raise a lot of capital, you need to dilute a lot, you get a lot of, investors on your cap table.
But Rahul, what do you tell this long-term investor? Do you tell them this 12 billion will become 30 billion or that 30
Absolutely.
billion will become 12 billion?
Yeah. See, long-term investors care for value a lot, right? And therefore, even during our IPO, we saw that a few folks stayed out because there was this expectation that we'll open at a discount, etc. So when we IPO'd at say 400 rupees per share and the stock went up to 600, during the first couple of months, what do you think the long-term, the investor, the patient investor who was sitting on the sidelines on IPO day or say before IPO, what do you think they were doing? Obviously sitting on the sidelines. So for you to be able to attract, I think, at the right value, so that they can come in and stay, I think solid, I think is important. I think we also have a certain journey to cross. I think Zomato, huge respect for them. They have led, they were really trailblazers in the way they were probably the first startup at scale in India to go public. There was no roadmap. I think they had to go through their trials and tribulations. They IPO'd at 8 billion, went up to 15, and then came crashing down to 5, and then built up again. So I think us watching from the sidelines gave us a lot of learnings, and kudos to them to have gone through their journey. It's very hard, right, to go through some of these what I call by really trials by fire.
One of the questions that I have is, in education especially, I like to think very long term. Like I said, we work with universities or partners on the other side who I often say they've been around 30 years, 50 years, some even more than 100 years, and they'll be around 30, 50, 100 years from now. And then when you think, how does that sit with being a public company where in many ways you're assessed on quarterly numbers? And I know you have a quarterly coming up in a couple of days, and that's definitely keeping you busy.
It's tomorrow.
So again, once again, really appreciate you giving us time just before your results. But how does this trade-off get managed at, say, Swiggy?
Yeah, no, I think it's a brilliant question, right? And we, as I said, we have certain parts of our business which are, at mature cash flow stage. There's a certain, path to profitability and path to steady state profitability that we are able to demonstrate. But there are also parts of the business that are in a growth phase, right? So for example, the quick commerce business, which as I had mentioned, it has kind of got up to from 0 to like $8 billion of gross order value in the last 3 years as an industry, right? Now this is taking the whole world by storm. I think India today probably has the best digital experience globally as consumers, right? So whether it is transactional payments or whether it is getting your groceries in 10 minutes, I think we enjoy some of the best convenience, from a global, perspective too. So for us, it's important to invest in a growth business. That business is, run rating at 100%, year-on-year growth, despite at the current scale. And this is across the industry, right? So we are seeing massive amount of consumer penetration and frequencies and, movement and increase in the overall consumption basket from these set of consumers. So it's very hard not to be investing in this, right? So I think public markets, while it's often said that they care for profitability a lot, I think that's what they say, but what they really look for is, really growth, right? And especially if you can demonstrate the profitability or path to profitability and are, growing at the pace that you would be a darling of the public market investors. So I don't think you should be afraid of, being in an investment phase that public market investors won't understand. I think it's our job to educate them that what are we seeing differently to be investing or being in a place where there are accounting losses or investments being made currently. So as long as you are able to show them the same, dream or the same path that you are on, I think they will be your backers.
So again, you actually answered my other question, which is growth versus profitability. But the good news seems like at least in Indian public markets, there is patience capital available if you're able to communicate to them the roadmap and the path that you're going to.
Oh, absolutely, right? I mean, we had probably no business to be listed, especially since we haven't still, delivered an accounting profit, right, at an overall consolidated level. But at the same time, you talked about some of the numbers here that, and we're doing reasonably well. And yeah, the roadmap looks pretty solid for us to be, and I think, as I said, it's our job to educate them, and I think they are also looking for exciting companies, especially platform companies like ours, where there is very, very little fixed investment, and there's a lot of operating leverage at play, with scale.
Okay. So I have one more question for you, and then maybe we'll open it up to the audience, and they may have some questions, and we have some questions submitted through the app as well, which we'll try and take. So if you can get just the mics out, that'll be good. So valuation. I mean, whether you're a public market company or a private market company, once you have taken investors, this is a question that comes up. How do you get valuation right? So do you price at the highest point of the band and make sure that your existing investors get all of the kind of the upside? Or do you leave some on the table for the retail and incoming investors at the cost of some of your existing investors? How do you manage that?
See, one thing about valuation is that, say, for example, when you start, make the decision to go public, there'll be all the investment banks will make very, very nice, PowerPoint presentations and spreadsheets, and to show how valuable you are.
I'm sure there are. We have investment banks also sponsoring, and I'm sure some of those presentations are being made as we speak.
Absolutely. No, no. So one thing which, in our pitching, decks that we had told the banks is to not show us a valuation slide. Because, you would be real soothsayers that if you are able to tell us 9 months ahead of the event, where will, our stock be trading at? So I think it's sometimes probably we overdo this whole valuation exercise. I think we should let the markets decide. The timing is something that you should, be in control of. There are obviously the micro and the macro factors, and some of it we talked about, and leave the rest to the market participants to decide. I think the public market investors do this for a living. We don't as companies. I think what we need to do is build fundamental value and leave the valuation for the public market investors. Now, having said that, when finally the decision is to be made, one thing that we always wanted was to leave some money on the table. Like, it's always good, even in our private rounds, we always, ensured that every investor is in the money on day one. And there are, ways in which you can do that. But for us, it was important that, especially since we are getting retail shareholders for the first time on our cap table, and like a 500,000 to 1 million shareholders who are coming in, many of them actually flip just for that, first week return. If they are going to lose money, that's going to leave a very, very, bad aftertaste. So it almost became important and paramount that you leave some money on the table. There is a good, aftermarket taste that you leave with investors who have, it was a large issue. So something that at least I would advocate that, your current investors, you should also show them that, a roadmap, right? So I don't think investors should exit just on the day of listing or, in the offer for sale. I think you should have a more orderly exit. Even if you have a larger size position, it's not possible for you to have a singular exit. So working along with the management team, working along with, the board, you should be able to draw a roadmap for how do these exits and orderly exits happen. And over time, there's a certain, weighted average price that you could get for the investment that you make.
I think, the consumer tech companies in India, the first wave of IPOs happened, I think, 4 or 5 years back. I don't think they left any money on the table. And that actually, then there was a lull after that. But this breed of companies, Swiggy is at the forefront, that happened last year especially. I think that has rekindled investor interest because you've actually made your pricing to be fairly fair. But anyway, with that, let's maybe see if there are any questions. Please try and keep it short. We have only about 7-8 minutes left. We'll try and keep answers short as well. So if you can just raise your hand, a mic will come to you. Okay. Yes. Just use the mic. There's one right next to you.
Hi, this is Srishti. I lead the Physics Wala Comms. I have a question. How do you manage issues and crises in this journey? What is that one mantra you can give how to manage those issues, any kind of issues through the IPO journey?
You mean during the listing journey?
During the listing journey.
Yeah, I think you should take a meditation course before you start the journey.
Thank you for that.
Right. I think
we'll be happy to create one for you.
I think on a serious note, once you're committed to it, and it is a very arduous journey, I have to admit, right? I think I still remember on the day of our, the first filing that we did, we did a first confidential filing. And, it was already, say, day 100 since we had kicked off, and, there were, 20 plus, investors who were selling in the IPO, etc., that amount of documentation, paperwork. Finally, I think we had a 72-hour marathon where we said, we'll complete it at this time on this day, and now let us, start, putting things together. So I think this almost like a Zen-like focus to be able to get to your desired outcome, because otherwise there'll be lots of elements that will keep stretching timelines, and which will seem out of your control. But at least my learning has been that everything is in your control, right? Every, stakeholder, every participant in that process has only one, objective in mind. Sometimes, this value addition can be value deletion in this whole process. The number of consultants, the number of, participants that are in the process can take a lot of tax from you. So I think just ensuring that you watch the traffic very, very closely, intervene at the right times, make decisions on a real-time basis, and stay focused on delivering on a certain timeline is very, very critical.
Yes, question in the back.
how do you account for the short-term kind of investor mindset these days on the public market? I mean, if you even look at the S&P 500 and the amount of companies that are public before and now, there's something to be said about how we want returns and how that can then limit the growth of a company and its innovation when you're having to report quarterly on your earnings.
No, see, you're absolutely right, right? See, it's a tightrope walk, right, to be honest. And, my personal experience suggests that, in the Indian context, there are a lot of mutual funds, etc. And we've heard that mutual fund money is long-term money. But in my personal experience, I've seen them, equivalent to hot money in many cases, right? Because they're also, at the end of the day, accountable to delivering a certain NAV, certain returns to their investors. They also have to be mindful of what are the external, macro forces impacting, not only the company valuations, but the sectoral valuations within the country. So all these, factors means that you still, as a company, have to still focus on delivering what is the best outcome for that long-term shareholder, right? And that's how at least we want to approach it. It's still early for us. It's month 4 of our listing journey. So probably I'm not an expert to state this. But having worked in public corporations earlier, one thing I can tell you is that, yes, there will be this, volatilities that you will have to manage. But all management teams who stay committed to building for the long term and on that vision. I mean, you just look at Amazon, right? There was a period of time in between 1997 to 2007, the stock did nothing. If you look at the returns for that stock over that one decade period, probably would be, in single digits. So the fact is, Bezos was, kudos to him to stay committed to what he was building and not getting, flustered with what's other outside, say short-term voices coming in. The same time, as I said, being a listed company, you can't take that element out, right? So you have to communicate, you have to be transparent, but then you really can't be building just for that quarterly earnings call, right?
I think, Rahul,
that's something which I strongly believe.
I think especially in the education context, this is like how it has to be done, right? You have to have a view that you're building for the long term with the right value systems and not try and worry about what happens on a quarterly basis. Otherwise, I think in education, especially in the education context, I think you'll then take a lot of missteps.
Oh, absolutely.
Okay, maybe one more question and then we'll wrap it up. Okay, there are 2 hands, so I have to choose, but I think that hand there went up first. If it's short, maybe we can get to you. There's a mic, I think, behind you.
Hi, good afternoon to both of you, and thank you so much for an enlightening session. This is Anuj from Genius Labs. So I have one very basic question that we want to understand. Like Swiggy is coming up with multiple products, like Instamart is also a new thing and all. So when you go in multiple offerings, what, as a CFO and as a leader of the industry, you think that we should move in the right direction? Is it the revenue or is it the innovation, or what exactly is the driving force to decide how much effort should go to which part?
Yeah. No, so again, there are frameworks that, every company will put in place. The way we think about our business across 3 horizons. So Horizon 1 are those mature businesses, Horizon 2 would be the growth investments, and Horizon 3 are the innovation bets. So, at every point in our life, we've ensured that we have a pretty good funnel of Horizon 3 bets. These are small innovation, funnels where, many entrepreneurs are given certain amount of capital and resources within the company to be able to incubate and, really act like startup within a startup, right? And once they demonstrate not only that product market fit, but also business market fit, more importantly, that while economics may not be delivered by that product and that experience, they need to demonstrate at least where will the, the levers for monetization and costs, really play out in the medium term. And once they demonstrate that, they get access to what we call growth capital, and they move to the Horizon 2 bucket. And from there, really depending on the overall TAM and the opportunity at play, the investment could vary between $10 million to maybe even $1 billion, right? And we have done that in our journey. So really, it's about backing the big bets and making those large outcomes possible while using certain amounts of frameworks and capital efficiency at play.
Okay, one last question with just 1 minute left. Yes, you had raised your hand before.
Hi, Rahul. The overall transition of Swiggy from, let's say, a startup to now a listed entity, what's been the impact on the teams that are actually executing on the ground? Because as a startup, you optimize for the pace of experimentation growth. And then when you transition, then it's a quarterly cycle. Then there are long-term projects like how Ashwin mentioned. So how have teams transitioned, and what would you suggest for those who are going along this journey?
No, I think, see, there are natural, say, forces at work. Say, for example, some individuals and teams just join that startup for that experience of continuously being, able to grow at, say, 0 to that 1 to 10x and 100x, right? And there are points in time when you have to take away growth investments and start focusing on building the mature model. And at that time, either you start transitioning them to other initiatives within the organization. So one thing which we have done really well is to identify these individuals and put them in the Horizon 3 bets or the incubation bets, because that's where they demonstrate the best outcomes. And then getting probably more seasoned talent into managing what we call the boring parts of the business, which is making profits, right, in the startup context. So I think there are horses for courses, identifying talent and their needs, and then really having the right staffing for the right business is very, very critical, and that is something that you have to absolutely manage on a real-time basis.
So just winding up, for me, Rahul, this was a very informative session. Two big takeaways. One is that you started very early, even perhaps when the team was not contemplating going public, but you were starting to build the relationships with public market investors, and that I think is a lesson for all of us. This is not a quick fix that we can decide to go public in a year and then we start the work for that. But I think more importantly, and for me, the biggest takeaway is that companies with good governance, good values, actually get a premium in public markets. And that is a very reassuring thought as we think about the implications of that in education. So thank you for your time. Good luck with your results tomorrow, and really appreciate you giving us your presence here.
Thank you so much.